You're looking at interest rates and you're wondering why you see so many different options. It's because investors can offer you different interest rates with respectively different price tags. Points, as an example, are price tags. Points allow you to buy yourself a lower interest rate than an investor may actually want to make off of you. So the rate a lender would offer you without any points would be called their par rate. That's what they feel is just a fair return on the money that they're lending you and the risk that you bring to the table. When I say the term points, I'm referring to 1%. So when you hear lenders saying this comes with 1 point or 2 points, they're referring to percentages. So 1 point's 1% of what you're borrowing, 2 points will be 2% of what you're borrowing. This cost is paid upfront at closing cash money from you. There's not equality when it comes to points, meaning it's not that you would pay, say, 1 point and get 0.5% off your interest rate. It doesn't automatically work like that. It's kind of like the stock market. The rates are always there every day, but the prices of those rates can change. And the spread between one rate and the next won't always be equal. So you may have on a Monday where you come in and let's say a 7% rate is zero cost. On that same Monday, 6.5 is only costing you 1 point to buy down to, 1% of what you're borrowing. Okay, so to go from 7 to 6.5 is 1 point. But then on Tuesday, all of a sudden, that 7% is still zero, but that 6.5 just turned into a 2-point buy down, double the cost, which will affect your return. That's an extreme example, but I just want to give you the idea that there really isn't any static that you can go off of here. It's not a constant. It's going to change every day. Whether or not paying points will make sense will change every day depending on the return on the investment. So that's why when you're shopping for a home, your best bet is to do your numbers as a bracket. Look at interest rates a little higher than they are, a little lower than they are, and consider 0 to 2 points in cost in your cash requirement just so that you have some padding in case you do want to buy the rate down when the time comes. A lot of folks are thinking, why would I pay points right now when I know rates are going to come down in the next couple of years? And that's a valid case, but the big question is when and how much? What rate do you think they're going to come down to? In some cases with rates right now, you can buy yourself into the rate that you think it'll come down to. Remember, with a refinance, they're not free. Even if the lender is waiving their lender fees, there's still charges. There are still title fees and escrow resets that you're going to have to account for. But hard costs, they could be running you anywhere between 0.5 to 1% of what you're borrowing on that refinance. So when you're doing your comparisons and looking at paying points today to buy that rate down, don't forget, if you're in the camp of rates coming down later, there's still going to be expense down the road to account for, so consider that in your calculations. Keep in mind, if you bring a lot of risk to the table, such as a low credit score, not putting a lot of money down, not a lot of reserves, high debt ratios, a unique property even, a cash out refinance, these types of situations bring an additional layer of risk that may force points being charged just because investors are concerned about their risk, even if you have a perfect profile outside of one of those components. So to bring it back to simple terms, is it worth it? Should you pay points to get yourself a lower interest rate? Well, it all comes down to the math. How much are you saving by buying this lower interest rate? Because that's what you're trying to do. You're trying to reduce the interest you pay. So how much are you actually saving over a monthly basis? How much are you spending for that up front? How much is this point or fraction of, because you can pay 1 point, you can pay 1.5 points, you can pay 0.5 point, and every eighth in between, by the way. So whatever amount of money you're paying in points, whatever fraction, how long will it take you to recapture that money through the monthly savings that you're going to be making? If that recapture period is at least half the time, if not shorter, of the expected time you'll keep that loan, that could be a good investment example if you think you're going to be in this house or this loan for, let's say, 7 years, and the cost to recapture that charge up front that you're paying, let's say you recapture that investment you make up front in 2 to 3 years. That's pretty good because you got your money back in 2 to 3 years, and you'll continue to save until you get out of there in year 7. So you don't invest in points just to get your money back. You want to see a return on it. When I look at pricing clients, I keep that in mind, but I also look at what's a good decision for them today. taking out some of that risk and some of that unknown. What do we have available today? Is it a good investment? And do you have the money to actually cover the expenses of buying an interest rate down? If you have consumer debts, credit cards, car loans, student loans, personal loans, money owed to the IRS, if you have any of those debt obligations, you need to take a hard look at what interest rates you're paying, because before you go buying yourself a lower rate on a mortgage, maybe paying off some consumer debt would be a better decision. So you got to look at the math and see what makes sense. Don't always look at the right now, look at the down the road as well. Where does this put you today? What will it look like in 3 years, in 5 years, in 7 years? Looking at it for 30 years or 15 years, truth is, you're probably not going to be in the house that long. Some may be. Most people move every 7 years. That's a good gauge, even if you're not sure yourself on how long you may be in this home. Go with a 7-year, maybe even a 5-year return and see what works best for you. Keep in mind, you can ask the seller to help offset some closing costs, but in a competitive market, you may or may not get it. And this is where a real estate agent will really serve you well. When you're making an offer on a home, 9.9 times out of 10, it's going to be more cost effective for you to get a credit to buy your rate down versus just drop the price. Every grand on a home is only going to change your payment about $7 a month with rates right now on a 30-year term. So take that money, use it to buy your rate down, and save a lot more that way. Let's go ahead and look at some examples on the math so you can get a feel of how this works and when it could make sense for you or your client. Okay, let's look at some rate comparisons. Before I pick out a couple of rates to do this comparison on, I do want to show you what a rate sheet looks like. Now, I just pulled this from another presentation. These rates are outdated at this stage, but it's just a grid to show you what a lender's really looking at when they pull up pricing. Now, keep in mind that when rates are quoted to a client, there's all kinds of variables that are going into it: credit score, down payment, location even is a piece of it, debt ratio, and I can go on and on. But long and short, when a lender pulls up rates, what they're gonna see is a whole spread of interest rates. So you can see in this example, my lowest rate this particular day was 4.25%. My highest rate was 6.625%, and I had everything in between. The question is, what were those rates costing you or not costing you? So in this example, this 4.25, if you needed to lock for 30 days as an example, and that's what this demonstrates: 15-day locks, 30-day locks, 45, 60. And a lock is really just how long you need the lender to lock that rate in until you close. And once you close, it's your permanent forever rate. But if you have a 30-day closing, we need to look at a 30-day lock period. So this 4.25 would cost you a whopping 4.444%, which is a very big price tag, especially on a $400,000 loan. That's based on your loan amount. So again, 1% is 1% of what you're borrowing. So in this case, 4%, I mean, you're well over $16,000. I'm sure even more, with the back end being 0.4. But nonetheless, this is what a lender looks at. And you can see there's not necessarily like an equality between all of these rates. There's kind of gaps that are bigger and smaller than one another. Sometimes they're inverted. And on this particular case, the 5.5% was cheaper than the 5.625%. And in this case, this is because this is a blended view of the best execution of all the investors who are lending that day. So you could break it out and kind of see which one, or each grid from each investor, but this is a blended view. So as a consumer, this is important for you to understand, because technically the rates are always there, right? There's all kinds of rates, and it's just which one do you want and which one makes sense. So let's go ahead and do an example. Now, when I did this example, I will tell you I updated rates to be more relative to the market today, so I didn't get anybody too excited per se. So let me go ahead and get this guy out of the way, and let's get into our calculations here. All right, so we're going to start with a rate of 7.5%, which would give you, and this is on a $400,000 30-year fixed rate loan. So at 7.5, you'd be looking at $27.96 principal and interest. This will be your 0 rate for the day. So this is what we compare everything else to. The cost, with that said, is 0, and the savings is non-existent as well, because you're really not comparing this to anything other than itself for future calculations. So in this example, this is your baseline. This would be considered your par interest rate, the rate that doesn't cost you anything. So now let's go ahead and take a look at some other rate options. Now I'm going to go quickly here because I'm going to summarize it at the end, but we're going to go 7.25, 7, 6.5. Okay. Now, what I want to show you here is that what you're looking at, rate spread, you're looking at the points associated, the cost that's translated because of these points based on your loan amount. You're looking at the savings you stand to make. And then ultimately, you're looking at what your return on investment is. Okay, so you can see 7.5% versus 6.5%. Let's just pick on that one and do some math. So the return on investment, and this is how you do the math. You take what you're spending, the $98.40, you divide it by what you're saving, which is $268. that monthly savings would recapture itself, meaning you'll get your $9,840 back in 36 months based off of you saving the $268. Then, if you break that out into years, that's 3.0583 years. I rounded it up here to 3.06. So, the return on investment is important because remember, like we said earlier, we want to make sure you're in the home for at least double the time it takes you to get your money back. That would make sense. Now, in some cases, people have money to burn and they're willing to take more of a risk. They're not sure how long you're going to be there. That's okay. But again, just make sure you're not, bypassing other consumer debt with higher interest rates. And back to that equality statement, you could see. So you have a 3-year return here, 2.5, and a 3. And this is pretty common. So the returns are going to move around on you. Just something to keep in mind. And you really will not know exactly what rate you're going to get until it comes time to lock in those rates. And ultimately, which rate will be best will be based off of these returns. And also, of course, how much cash you just really have and what kind of payment you really want. So these are all just, again, for now, informational. And as you start seeing properties or if you are able to lock in a rate, this is the kind of thing that a lender, a very good lender, I should say, would be able to do for you. Not all will. They'll just give you a rate and say, here's your rate. And as a consumer, it's important for you to know there are a lot of rates on the board. So I always tell my clients, you can get any rate you want with any lender. It's just a matter of what you are or are not paying for it. Remember that rate grid, all the rates are there. The other thing I like to tell folks who are floating is that the rates technically are always going to be there. It's the price tag that's changing. So if you're worried about rates going up, know that you can more or less buy that rate if you wanted to, if rates happen to quote unquote go up. Respectively, you'd be paying money for it. That's where those points come in. So just keep that in mind. The rates are always there. It's the price tags that changes. For more home buying tips, be sure to follow us.